Thank you for joining us, and welcome to tonight's webinar. Today's topic is how to invest in apartments. For your questions, please type them in the chat box and that will be addressed after the presentation. To those who are in Facebook, please enter your questions in the comment section. And now, without further ado, here's our host, Mr. Yan Lam.
All right. Thank you so much, Connie, for the wonderful, warm introduction. And tonight, guys, I'm super excited about our topic. Multifamily is probably everyone's dream end goal for real estate because it produces both equity growth and also cash flow. So, for those who are just joining in, just want to let you guys know that this is being recorded, so that way you guys can it can be referenced in the future. For those who are on Facebook, welcome. I look forward to seeing your questions as well. So, looking forward to seeing in the chat box. So, for those who don't know me, my name is Jan. I've been doing real estate for the past 11 years now, starting with regular fix and flip, and now our business has matured to many different facets of real estate. So, started off part time. I had a full time job as an engineer for the federal government, and was like most middle class Americans, where we're just fighting along the wall with the rat race. Within 2.5 years of doing real estate part time, I was able to replace my full time job and have been doing real estate full time ever since then, and continue on from there. So, multifamily investing. Now, what is it? Okay, why is it different and more beneficial than a regular one unit townhouse that you can buy and rent out? Well, let's go through a couple of things. Okay, why should you do it first of all? Well, first of all, it gives you long term wealth. Okay, very common sense. You buy a piece of property, you rent it out. The tenant pays rent. The rent pays for the mortgage, which pays for interest and also principal, pays down your mortgage, and you increase your wealth over time with equity because your tenant is paying down your mortgage for you. Also, from a tax perspective, depreciation. You can depreciate legally the building value of your house over time as it gets older, so you offset your tax liability. Also, as long as your expenses are less than your income, then you have positive cash flow coming in, whether you work or not. Now, reasons on why you should invest in multifamily. All right. And so investing in real estate, you have controlled appreciation through value add strategies. Okay. So when you start doing a piece of real estate property, you can gamble with it and hope the market improves, or you can do some specific value add that control depreciation. Okay. Um, all right. Now, the more units you have, the less risk you have, and especially if you're in the right market. Now, if you have one unit, and if you have one tenant that leaves you, guess what? You now have 100% vacancy, and you have no cash flow coming in. But the more units you have, even though you have one vacancy, it won't hurt you as much because you have so many units. All right. Less competition. The average person will want to do a regular one unit buy and hold just because it's low risk, easy to do, and it seems less scary, right? So why is there less competition? Very common sense, right? Well, people don't try because they think there's too much competition, or maybe the dollar amount scares them. So instead of buying a $200,000 townhouse or $300,000 townhouse, they're looking at things that are 10, 20, $30 million to be able to buy 100, 200, 300 units in any particular marketplace. So that scares off a lot of small investors, all right? Especially those who watch HGTV and think they got it. Lack of education. So if you don't know, you don't know. So that's why we want to go through this webinar, so that way you know a little bit more and you're not as fearful of doing multifamily as a normal person would, okay? And also, you got to have efficient and proven systems to succeed, because you don't have that, then you shoot in the dark with trial and error, and the trial and error will waste time and also cost money, okay? So with that, guys, I am super excited about introducing our guest speaker for this evening. Mr. Daniel Woodford is actually part of Mission Bay. He actually was not available today, but we got the next best thing, which is his equity partner, Christine Jefferson, and she's been with Daniel for the last several years. And I'll tell you guys, they've gone from very little units in a period of a span of 3 to 4 years, got thousands of units under the belt that's been bought, value added, and also sold. And they're doing it over and over and over again with value add and improving systems. So without further ado, please welcome Miss Christine Jefferson. Christine, I turn it over to you.
Thank you, Jan. I appreciate that. And great to be here. And thanks for allowing me to take Daniel's spot. So as Jan said, Daniel is my business partner, and he is everything to us and our business. And hopefully next time he'll be able to be on, because you're You'll miss not hearing him tonight, but I'll do my best to fill his shoes. So we are co-founders of Mission Bay Capital Partners, and we've been doing this together since 2017. So I'm going to give you an aerial view of a syndication and investing in multifamily. And multifamily properties are valued based on the income that they make. And then it's multiplied by the cap rate or capitalization rate in the area. It's different in some areas than in other areas, but that's how a multifamily property is valued. So the higher the income, the higher the value of the property, regardless of the property that's sold next door. So it's not based so much off of what's selling around it, but more on what the property is making. And as Nhan mentioned earlier, the more value you can add to the property and bring the expenses down or the income up of the property, the higher the property will be valued. So, and also when we're going in scale of 100-unit apartment building, when you increase the rent or decrease, primarily increase the rent, but of course, decrease the expenses. But let's say we increase the rent by $25, which doesn't sound like a lot, but if you increase the rent by $25, that's 100 doors, 100 units over a 12-month period at a 7% capitalization rate, which I'll get into in a minute. You've just increased the value of the property by $428,500 by increasing the $25 a door. So just think about that, because that $25 can be rental increase or charging pet fees, billing back water to the tenants that they aren't currently being billed. So there are ways to increase that pretty quickly when acquiring a property, and something that you can anticipate for before you purchase. So a capitalization rate, it's kind of opposite in thinking. It's a multiplier that's applied to the income. So the capitalization rate, the lower the capitalization rate, the higher the value. It's kind of opposite thinking. So for instance, in our DC metropolitan area, and especially in DC, it's a lower cap rate. You'll see 2 to 4% cap rate in those areas. And secondary and tertiary markets, you'll see a little bit of a higher cap rate. And the capitalization rates are a little bit compressed right now. And then in areas that are a little less desirable, you'll see a higher cap rate in those areas. The cap rates that are the lower ones in such as the DC or New York City, those are primarily purchased by institutional investors, insurance companies that are okay achieving a steady lower interest rate. So also with multifamily, the loans are not based on, well, once you get to a certain price point. I'm not talking 5 units. So the properties we buy are primarily 75 units and above. Our largest acquisition is 271 units currently. But so the loan is based off of the income of the property. It's not based off of your job, your credit, your W-2. That does not come into play at all. It's based off of the property. So lenders really dig into the property itself and the area. They do not dig into you personally as far as what you make. And also, if the loan is over $1 million, it's also not personally guaranteed by yourself either. It's all based on the property. And typically, a multifamily purchase is a longer term hold. It's not a fix and flip, get rich kind of scheme. I like to call it delayed gratification because it does take some time to satisfy the business plan of the property going into it, to raise those rents, $25 or more, not rents, but income per unit, $25 or more. So it takes a longer time to satisfy the business plan and add the value to the property. So we typically underwrite for 5 to 7 years. Not to say that it won't sell sooner than that, but that's what we anticipate our holds for. And just also, once investors invest in a property, their money is in there for a year. So just plan on it being parked there for at least a year. Investors are not able to get their cash out for the first year of the property, or their original capital out for the first 12 months of the property. And they're less volatile than single family values. The market and interest rates do affect multifamily, but not as sensitively as it affects the single family housing world. So again, it's based more on the income. People still need a place to rent. During recession, during COVID, it was still a great time to buy. And it was also a great time for us to sell as well. But it's less of an up and down market than single family homes are. So there are 3, and then you can throw in A minuses to C minuses in here, but there's a range of multifamily buildings that we primarily invest in and that we look for. You'll see Class D missing from this because that is the lowest class of apartment building. It's a little bit of a war zone area, an area that may throw off some good cash flow, but the appreciation, the management hassles, the vacancy, getting lending, it's too risky for what we're looking for and for our deal criteria. So you will not see Class D here in our category. So Class A is on the newer side, or more recently built, needing less cosmetic or capital expenditures. Not to say that there isn't value add in that property. We actually did come across a Class A property where we found a way to add value, and it was management. They had too many people, too many employees on staff, and we knew going in that was a very good way that we can add value to the property, was just reducing the overhead and the amount of employees and what they were anticipating payroll per unit. So just because it is a newer building doesn't mean that there is not a way to add value. There are ways to add value, not only cosmetically and capital repairs, but also operationally and management. Class B, and we like to stay between A minus and I would say C plus. And C plus would be okay if it's in a B area. So you can buy a property to bring up to the area that it's in. And B, we like too. It's a little bit older, but there's definitely ways that we can add value to it. It's most likely a property that hasn't changed hands too many times. And we have the opportunity to, raise rents if it hasn't been done in a while. And a lot of times the property management companies like to keep the occupancy higher, so then they don't raise rents. So we have an opportunity as a new owner coming in to raise the rents as we go along. And Class C is, I would say, 70s, late 60s, 70s, mid 70s vintage. So it's a little older. It has more issues, plumbing, cosmetic and plumbing and piping and wiring. It just has more. And as long as it's budgeted in the underwriting, it's okay if your numbers work out for that. And insurance might be a little higher on those kind of properties. But for us, we like to stick with A to C plus. And so the downside of multifamily, and there really it's still a positive, is it is illiquid. So your money is parked there. It's not a get in and get out kind of deal. As an investor in an apartment building, investing in a syndication, which I'll get to in a minute what a syndication is, it's the investor is you're a passive investor if you're investing in the syndication, meaning it's a hands-off investment. You're a limited partner, and the operators, managers, such as Daniel and myself, do all of the work of managing the property, managing your asset. So the investors just park their money in this and trust that will be good stewards of their money. And it is a little more tricky to use a 1031 benefit than single family. It can still be done. It's just, to make it worthwhile, needs to be more of an investment or more of a rollover, a higher rollover. There are legal things that go into it, and tenant in common is formed, and it is possible. We just look to have a particular dollar amount that is being rolled over, but it can totally be done. So, and as most people on this call know, rent's not going away. Actually, the rental market is kind of a little high right now. It's creeped up, but we all know that renters, millennial renting, newer graduates renting, it's here to stay. So we feel that there'll always be a place for investing in multifamily. Okay, so a syndication, there are ways to purchase multifamily. You can JV partner with somebody and go in it together, and maybe your JV partner does the money, you find the building, and you split it. However, you can do it that way, or what we do is something called a syndication, where we bring in the equity, we bring in investor dollars to help purchase the property. So we get a bank loan, and then a bunch of people invest their money into the LLC. They buy shares of the LLC that owns the property. So they're investing in the property itself. And a syndication and so they're limited partners, they're hands-off investing. And it's just when all the money's pooled together, and it's governed by the Securities and Exchange Commission. So it does come with legal documents that every investor that is invested in a syndication signs. They get a private placement memorandum and a subscription agreement and a questionnaire. And it allows the ability to buy larger apartment or multifamily complexes than we could with just one partner, or just using your own money, which using your own money you will run out on the quicker side versus using other people's investment dollars. So Daniel and I do use our money when we do buy a property. We always invest, and there's a lot of money that goes in upfront to acquire a property. But just using a syndication allows us to get something larger. So we typically do a 3 to 5 million syndication per acquisition. So, and with that, then we can get something, $10 to $15 million and upwards with pooling together investors' money of that amount. So it allows us to scale up. So the way it's split up is that the management team typically gets 25% equity, and the investors typically get 75% equity. So the returns that we like to see for our investors when we underwrite a deal is 15 to 17% average annual rate of return. There's actually a couple of metrics we like to look at. That's one of them, is a 15 to 17% average annual rate of return. That means if an investor were to add up all of their cash flow checks that they receive over the hold period and the equity received at sale, and they average that out over the hold period, then their return would be about 15 to 17%. So if somebody invested $100,000, then that means their money will have made about $15,000, dollars a year. Another metric we look at, I don't know if that's coming up next, but another metric we look at is equity multiplier. We like to say that we like to almost double our investors' money on a 5-year hold. So if somebody invests $100,000, they can expect to have made almost 100, let's say 80 to $90,000 within that 5-year time frame. So those are metrics we like to see before we would ever even move forward on purchasing a property. Okay, so here's an example of somebody did vest. I'm sorry, the numbers are a little wonky on here, but I'll walk you through this. So if somebody invested $100,000, and typically we pay a 7% preferred rate of return from the cash flow of the property. So, every year they can expect $7,000. And if they were to add all of those $7,000 checks and $45,000 when we sold the property, and that's what the investor made, that means they made, $80,000 off of their $100,000. So they get the $100,000 back, and then we'll have made $80,000, which would mean a 16.5% return on investment. So the stages of acquiring and purchasing a multi-family property is we send in a pre-offer, an LOI, or also called a letter of intent. So that's not it. It is signed. It's not binding, but it's pre-contract. So if we are interested, we do have our terms in the pre-offer and the letter of intent. Once we go to terms verbally back and forth on that. Once that's verbally accepted, we go to contract, purchase and sales agreement. And once that is all negotiated, everything is signed, and we start our due diligence. For investors, we let them know that we have something that we're looking at, which would be in the close to the letter of intent stage. When we start our due diligence, we let our investors know that we have something that's coming up in the pipeline, and we give them an idea of the returns and the underwriting and the market, where the property is located, and a little bit of a business plan. After due diligence, and we know we're moving forward on purchasing it, that's when we do the legal documents for our investors, and then we notify them with the HUD once we close on the property. So these are all the things we do pre-offer, the terms. So during due diligence, and we do have a lot of documents that we collect from the seller over that. So everything's audited. The leases are audited. The property manager that we're hiring goes to the property. We walk every single unit. We go inside, even if it's 150 units, we go inside every unit possible, and just get a feel of the repairs that the property needs, the capital repairs. So the property management jots down condition of the property, so we know in our underwriting if we need to replace half of the appliances on the property. So we do all the inspections, survey, environmental, just walk the property, and also get a scope of the area that it's in. Once we have gone through our due diligence and everything is verified, and all the numbers are verified, then we go ahead and about 30 days later, we go ahead and close on the property. So post-purchase, this is where the money is really made in multifamily. It is a little bit made during the purchase price, but it's mostly made during the asset management piece of the property. And this is where what you don't know can hurt you in the management of the property, and increasing that income, and getting this property along, and making it a great investment. And that's where that's done, is just tenants, managing the asset, handling evictions. And again, we hire a third-party property management company to do this, and we also hire an asset management company to do this. But in the beginning, We always did a third party because it's usually 100 units and above. So it requires a third party property manager. Or if you want to manage it yourself to learn, I would suggest starting smaller than 100 units as well, and having a software system for that. But so, yeah, managing the property, efficiencies. Once the property stabilized and running the way we want to, we aim, once we know that we've not only achieved, but close to exceeded our investors' returns, and it starts to level off, we usually look to go ahead and put the property for sale. So in underwriting, we have a very conservative way that we underwrite our properties. Most people do not put enough money in reserves, and it has paid off for us well in having over anticipating reserve money needed. We usually have several $100,000 that we set aside for reserves. One of the properties we bought in Columbia, South Carolina, we bought it in 2020. And just as we were closing, the lender was like, oh, we're shutting down, like they weren't lending. This was March of 2020. And then we were buying, and then like, well, in order for you to close now, like this was like 48 hours before closing. In order for you to close now, we need you to come up with a year's worth of interest. And, our mortgage is $60,000 on that property a month. So to come up with that amount of interest would be a lot of money. And we had already raised more than we needed to have the reserves. So we had the money, so we were able to close. And we still have reserves after that. So it's always a good thing. You never know what's going to happen if an insurance claim was going to happen and you need to come up with a deductible. So it's always good to have a healthy amount of reserves, a very conservative rent and expense growth, like trickling in the rent phase, like not having all of the rents increase in 1 year is just not realistic or possible. So phasing in rents over, a 3-year time span, having enough for renovations and contractor services, being conservative on the investment timeline, which is why we underwrite longer than needed to make sure it will perform still. And then exit cap rate, interestingly enough, we come back to cap rate. So upon purchase, let's say we buy at a 6% cap rate. In underwriting, you need the cap rate needs to be higher than the purchase cap rate to be conservative. So we like to add a 0.1 to the cap rate every year that we hold the property, just to be conservative. And if the cap rates happen to go crazy and change unexpectedly, we have that buffer and reserve for the exit, for conservatively underwriting an exit cap rate. So the great thing about investing in multifamily, and this is more for investors than it is for this is more for passive investors than it is for general partners or being an active investor. It's just because the cash flow goes first to the investors, so then it would trickle down to the general partners. So really, and then we just put that in reserves for the property. So really, for realistically, most of the money is made at purchase, during for acquisition fees, asset management, and then again at sale. And again, we're also not in the cash flow heavy categories. We're more in the appreciation categories. So what else is great is forced appreciation, which you can get by increasing the NOI, by increasing the income. You're appreciating the property. inflation protection, tax benefits. Jan mentioned this earlier. It's great all around. Whether you're investing passively, you're still owner of the property. You're owner of the LLC that owns the property, so you appreciate in the depreciation. You get to realize the depreciation that way. And if it's also you are the general partner, you get the same tax. You get tax benefits as well for your ownership in the property. So, and what's even great is if you are a full-time real estate investor, like I am, you get to depreciate it all in that year. So it doesn't, if you're not a full-time investor, the losses get off of your passive income. Where if you're a full-time investor, you can take it all. Like you would have a negative cash flow year. You're at a loss, which is, on a side note, great when you have kids in college. Just saying that, because then it shows you're not. Anyway, it's beneficial. It's been beneficial for me when filling out the FAFSA. Okay, and then economies of scale and investing with your IRA 401. That applies to investors. Just you can have a self-directed IRA. So it's a great way to share that with investors that most people don't realize that they can invest with their retirement funds by creating a custodial account and self-direct their money into a syndication. So a little bit about Daniel, who wasn't able to be here tonight. He started investing in multifamily in 2013 and retired Air Force. He was at the Pentagon for many years, and we actually both were in the single family fix and flip business for many years. He transitioned over to apartment investing before I did. We met at Jan's meetup. I think Jan might have even matchmaked us. Yeah. And we sat together at one of Christmas holiday parties. And I was just starting at the time in apartment investing. And so we met and we balanced each other out very well. We have since brought on an acquisition associate who does a lot of underwriting. So we have brought an underwriter onto our team. Before that, he was the primary underwriter and works with banks and just does a multitude of things. And I'm more on the capital raising side of things, syndication side, but we've both worked just very hard to get our company where it is today. And it's been a really blessing to have our partnership that we do. And Daniel is an amazing partner that I am blessed to be with. So we have, this is just a little bit about our track record. The ones in gray are properties that we have bought and sold. And the units, so you can see we average on the higher end. And I'm telling you, it's just the same amount of work as an 18 unit building. And I say that because I almost started with one and I did all the legwork for it. I didn't go through with it, but it was a lot. But multifamily is all about partnering up and forming partnerships. And it's something that you definitely want to partner on to grow. It is a partnership path. So this just shows you that what the AAR is, the average annual rate of return. The IRR is just kind of like time value of money. Just because $1 or $10 today is not going to be worth $10 6 months from now, even with the way gas is going. So the IRR is just time value of money. So we like to see 14% and above, and these are the IRRs that we've achieved. The lowest is 16.6, which is, it doesn't look good on here, but it's very good to get a 14% IRR. And cash on cash, we do like to see around 8%, but some of these properties weren't expecting to provide cash in the beginning terms of it. So these are the ones we've sold. These are the ones that we are projecting to sell this year. And this one here is currently on the market as of this one. And if you have been on prior calls with Daniel, he has talked about this property before, and this is the anticipated price that we're targeting to sell it for. And this one hasn't been held that long to increase. So we've added a lot of value to this property. So I guess we can open it for questions if we have any. If not, I can talk further on one particular topic if you'd like.
Yeah, absolutely. Well, first of all, Christine, for those who don't know Christine, I mean, both her and Daniel are very humble, and these are great achievements. And as she said, no matter how big or small unit it is, it requires the same amount of work. But look at the differences in value that you create in one particular investment. So yeah, Christine, feel free to add a couple more things that you like, and then afterwards we can take questions.
Sure. Let's see what I can speak to. Whoops. I didn't mean to do that. I can talk more about, I guess underwriting is a big thing. So in getting started and investing in multifamily, there are kind of two. It's great to know all aspects of it, but there are really two avenues that people tend to gravitate towards. One is raising capital, and somebody can get involved, and that's how I started. That's how Daniel and I started together. Is I raised capital for one of the ones you saw on the track record and that had sold. I raised capital for that acquisition, and that's how I got started in the business. And I went on the due diligence trip. It was a property in Texas, and just there is a way to get involved and get on the general partnership team and start getting your feet in investing in multifamily on the general partnership side is raising capital and bringing money to the deal. And that's how I got started. Daniel is more, and he's gravitates towards the other route, which is, and since we've been together, we have raised about $26 million and have about 300, a little less than 300 investors since we've partnered. And Daniel he's analytical. He loves underwriting. He loves the numbers, and he loves spreadsheets. And I don't. So we have a really good balance with each other. As far as what he brings to the table and what I bring to the table. And so it forms a great partnership. So if you're someone that's more analytical, engineer thinking, and like the numbers and likes the spreadsheets and likes the underwriting, loves to underwrite deals, then you can always bring a deal to a sponsor, to somebody, and partner that way. Because you can be part of on the general partnership team as well, finding a property and bringing it to somebody that can raise capital. So there have been a lot of partnerships formed that way, where one does one job and one does the other. But it is a team. It's a team sport. It takes many hands and a few general partners to get a deal done. And do you want me to just answer the question I see, or did you want to read it? Or
we can go ahead and go through the questions now. So as you guys are listening on, for those who have questions, feel free to start typing the questions in Facebook in the comment section, and also in the chat tool here. on Click Meeting. Okay, so I'll read out the questions for everybody to hear, and then Christine, I'll let you go ahead and answer them. Okay, so first question is from Sandy Warren, and the question is, can I withdraw my investment prior to selling the property? How long of a notice is needed, and what's the minimum dollar investment?
Yes, well, it's not really a withdrawal of your money. So as an investor, you're subscribing to shares. So you're buying shares into the LLC that owns the property. So let's say you invested, and I always use 100,000 because it's an easy number. So say you invested $100,000. You per SEC rules and regulations, you cannot get it out the first year. That's just how the rulings are. So it is in there for 12 months. If after 12 months you are at a hardship, something happens and you really need your capital back, Daniel and I will we will certainly abide by that, and you will get your capital back. The thing is, you'd be selling your shares. So you're selling your shares, and then that's how you get your money back. Then the first people that would be offered to would be the general partnership team. And then after that, the current investors. And then after that, we would go out and just raise it to replace. With that said, of all of the money that we've raised over the years and the properties that we've only had one investor that needed their money back. So it's important to say, when I do speak to potential investors, that they're not investing their last savings amount, and that this is money that you can part with for 5 to 7 years. But, with that said, we would, if you definitely, if you need your money back, we would do everything to get you your capital back. It might, you might not make the money on it that you thought, and it does cost us money as well to sell your shares, because then that affects the tax documents and selling halfway through the year. So it affects the K-1s. So it's a couple $1,000s too that goes into it. Fees, legal fees, and legal fees from the attorney and from the CPA. So it costs a little bit, but it is something that we would do everything we can if a hardship were to come up. And the minimum investment is 50,000.
Okay, wonderful. So 50,000 minimum investment, and it can be done, but if you can hold out, then definitely try your best. Okay, great. Are there any
Yeah.
other questions for Christine here? And I see some people typing here, but Christine, I know we go way back from the fix and flip days, right? And I know Daniel was doing fix and flips as well, but you guys gravitated towards multifamily, and you guys have achieved so much from that, I guess, that initial meeting, and you guys really hit it off with a great partnership and skill sets that just complement each other. So congratulations on your success, and looking forward to seeing this much, much more in the very near future. All right. So it looks like we don't have any more questions. So Christine, we really do value your time, and thank you so much for coming along, joining us today. Please send our regards to Daniel, and hopefully we'll get you again in a future meetup down the road when the topic fits.
Thank you for having me.
Thank you very much, Christine. I appreciate it. And for those who are listening on, if you know anyone who's interested in this topic, definitely refer them to our Facebook page, because this recording will be there live and can be referenced in the very near future. Okay. Now, next month, our topic is going to be how to find funding for your deals. Now, whether it be a rental deal, a fix and flip deal, or a multifamily deal, we're going to go through what the different strategies that we personally go through to be able to raise money. One of the biggest skills that you need in real estate investing, there's two of them that I really focus on. Number one is how to find a deal, and number two, how to find the money. It's always finding something, right? So if you're good at sourcing deals and sourcing money, you got this concept made. So to register for next month's event, make sure you click on the red button on the top. It says register here, reserve your spot right now, and get reminded on when the event comes. And also, we're actually going to be having a guest speaker from one of our partners that does a lot of capital raising, a lot of funding for real estate deals, up into words of $10 to $20 million per deal in the DC metropolitan area. So definitely look forward to having him join us to share with his take on what's going on, where the direction the market is, how interest rate increases from the Federal Reserve are affecting smaller investments and fix and flips, or bigger investments such as condo conversions and multifamily buildings as well. So make sure you click on that button to reserve your spot. And we'll see everyone on July 13th next month on how to find funding for all your deals. Thank you very much. Have a great night and God bless.